Good afternoon and welcome to the Morrows Monthly update for January. January was a volatile month for most asset classes due to the US Federal Reserve winding back its stimulus program by a further $10 billion. This had a particularly large impact on emerging markets, some of which saw their currencies depreciate by more than 10% during the month. The Australian equity market finished lower by around 3% in January. Global equities also retreated, with Japan down around 8%, the US down 4% and Europe down 2%. Emerging markets were also weaker, with China finishing down around 2% for the month. Global bond yields fell as risk aversion set in, with the US 10-year Treasury yield falling from 3% down towards 2.6%. Some emerging market bond yields did, however, rise as investors began to question their underlying fundamentals in the absence of further global stimulus. Commodities were generally weaker, although we did see gold finish marginally higher for the month. Oil prices were slightly lower. The US dollar was stronger against the euro and the pound, but weaker against the Japanese yen. The Aussie dollar finished down around 2% against the US dollar, was flat against the euro and finished lower against the pound. US economic data was generally positive in January, despite both the manufacturing and services sectors falling slightly. Trade data, retail sales and industrial production all beat expectations, and inflation was relatively low at 1.5% year on year. Despite a very poor jobs growth number, the unemployment rate did decline to 6.7%, and preliminary figures for fourth quarter GDP estimates came out at 3.2%. Economic data out of Europe was generally positive, with both the manufacturing sectors and the services sector expanding, and industrial production and retail sales were also quite strong. Inflation came out at 0.8% year on year, which is somewhat of a concern, as is the relatively high level of unemployment. Data out of China was generally negative, with the manufacturing sector contracting and the services sector hitting a 2-year low. Industrial production and retail sales came out in line with expectation, whilst trade data disappointed. Fourth quarter GDP came out slightly stronger than expected to record a 7.7% year-on-year number. In Australia, the manufacturing sector contracted for the second month in a row, and consumer sentiment remained soft. Business confidence, however, did hit a 2.5-year high, and retail sales beat expectations. The unemployment rate was relatively flat at 5.8%. However, inflation data came out slightly higher than expected at 2.7% year on year. At its February meeting, the RBA left interest rates on hold at 2.5%. Headline economic data was mostly positive in January. However, 2014 has started off negatively for most risk asset classes. Poor manufacturing data out of China was one of the triggers for the recent market sell-off, and this, combined with a relatively soft US earnings outlook and increasing volatility out of emerging markets, has seen many investors move back towards safe haven assets. 2013 was an abnormally low year for volatility, and we expect volatility to pick up going forward, particularly as markets try and navigate their way through an environment in which the US Federal Reserve is winding back its stimulus measures. We've been warning for some time that the market was due for a correction, and whilst the timing and magnitude of such events are always difficult to forecast, we're yet to see whether this current correction turns into anything more meaningful. Our portfolios remain defensively positioned, and we have in place strategies to protect against some of the downside risk should the market correction continue. We thank you for your time and look forward to talking to you again next month.